This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Imagine someone offered to sell you a local coffee shop. Before handing over your money, you'd probably ask some questions. How much money does it make? Is it growing? Does it have lots of debt? Who are the competitors? Could it survive a recession? Buying shares should be no different. When you buy shares, you're buying part ownership of a real business. Fundamental analysis is simply the process of deciding whether that business is worth owning. In this video, we'll explain what fundamental analysis is, what investors actually look for, and how beginners can avoid getting overwhelmed by hundreds of financial numbers. Fundamental analysis means looking at the actual business behind the share price. Rather than asking, will the price go up tomorrow? You're asking, is this a good business that could become more valuable over time? Instead of studying charts, you study the company itself, its products, its customers, its profits, its debt, its management, its competitors, and its future. The goal isn't to predict tomorrow's price. The goal is to estimate what the business is really worth. Imagine buying 100% of a business. You wouldn't buy it because the share price went up yesterday. You'd buy it because the business earns money, produces valuable products, has loyal customers, and can continue growing. When you buy shares, you should think exactly the same way. Even though you might only own a tiny fraction of the company, you're still becoming a part owner. Successful investors often think like business owners, not gamblers. While professionals analyze hundreds of numbers, most long-term investors focus on four main areas. Is the company growing? Is it making consistent profits? Does it have manageable debt? And does it have a competitive advantage that helps it stay successful? If those four areas are strong, many of the smaller details become much easier to understand. Revenue is simply all the money a company brings in through sales. Profit is what's left after paying the bills. A company can have billions in sales, but still lose money. That's why experienced investors care far more about profits than revenue alone. Growing revenue is important, but profitable growth is even better. Debt isn't automatically bad. Many successful companies borrow money to expand. The problem comes when debt becomes difficult to repay. Higher interest rates can increase borrowing costs. During recessions, companies with too much debt often struggle the most. Many investors prefer businesses that can comfortably pay their debts while continuing to grow. One of the most important questions is, why can't another company simply copy this business? Some businesses have famous brands. Others own valuable technology. Some have patents. Some dominate their industry. Others benefit from huge customer networks. These advantages help companies remain profitable for many years. Investors often call this an economic moat. Just like a castle moat protected castles, an economic moat helps protect a business from competitors. Even the best business can be damaged by poor management. Leaders decide where money is invested, whether acquisitions are made, how much debt the company takes on, and how profits are returned to shareholders. Many investors spend time reading annual reports and listening to management presentations before investing. A great business isn't always a great investment. Price matters. Imagine paying $500,000 for a modest house worth $300,000. Even though it's a good house, you've probably paid too much. Shares work the same way. A fantastic company can still be a poor investment if investors become too optimistic and push the price far above its true value. That's why investors compare the company's value with its current share price. If you're just getting started, don't try to memorize dozens of financial ratios. Instead, ask a few simple questions. Does the company make money? Are profits growing? Can it comfortably manage its debt? Does it have an advantage over competitors? And do I understand how this business actually makes money? If you can't explain the business simply, it may be worth researching it further before investing. Fundamental analysis isn't about predicting tomorrow's share price. It's about understanding the business you're buying. The better you understand the company, the more confident you'll be during market ups and downs. In later videos, we'll break down the individual financial measurements investors use, including earnings per share, price to earnings ratios, cash flow, and return on equity. If you found this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel grow. Thanks for watching, and I'll see you in the next video.